What's good, everybody? It's Alex Comunio here, and I'm back with another video. And in this video, I'm going to be talking about investing in the stock market versus investing in real estate. Let's get into today's video.
I guess I got my swagger back.
Hello and welcome to the TIIV Championship, aka the Ideal Investment Vehicle Championship, presented by ESPN on this Sunday evening here downtown Los Angeles at the Staples Center. I'm Mike Breen, and joining me today are Jeff Van Gundy and Mark Jackson for this championship telecast of today's game between Warren Buffett and the stock investors taking on Grant Cardone and the real estate investors. What a matchup we have today. And joining us is our courtside reporter, Alex Comunio. Alex?
We have a showdown for you today. Coming in with an unblemished 49-0 record, we have stock investing. Coming in with also an unblemished 49-0 record, we have real estate investing. These two will be going up against each other in 5 rounds that will determine which one of these will be the ideal investment vehicle for you. So those 5 rounds will be income, depreciation, equity, appreciation, and leverage. Of course, I'll be explaining what each one of these means as we go through every round, but whoever does take a majority of the rounds, meaning 3 out of 5, will be crowned as the best investment vehicle. So without further ado, round 1, income. Of course, this channel is all about financial freedom, which if you are new here and you don't know what financial freedom is the ability to live off of passive income from assets that you've invested in so that you don't have to trade in your time for money. So of course, the ideal investment vehicle needs to produce you income. So what is income when it comes to real estate? Of course, income is the rent, right? But that's not the profit that you get to take home, right? When you own real estate, you get rent from your tenants, but of course you have to pay your expenses. You know, your mortgage, your taxes, your insurance. So everything left over is your cash flow. So the cash flow is what you're able to live off of. When you buy real estate, you should only be buying real estate that cash flows. Now, when it comes to stocks, you're only getting income if that company's stock is paying a dividend. A dividend is a portion of the company's profits that they're sharing with its shareholders. Now, unfortunately, the average dividend yield is only about 3%, so it's not very high. So that means if I bought a company's stock for $100, I would only be getting a dividend of $3 every time they pay their dividend out, which it could be quarterly, it could be monthly, it could be yearly, who knows? But that's a very low percentage in my opinion. So round 1 income will be going to real estate. So round 2, depreciation. What is depreciation? Depreciation is the deduction in the value of an asset due to wear and tear over time. So essentially that means if you own anything that's a physical asset or anything that's a physical anything, it loses value over time. So the IRS allows you to take a paper loss when it's time to do your taxes. So depreciation is a tax benefit. So because when you own a business, you're able to deduct expenses from your income and then are taxed on that net. When you own an asset, you're able to take the wear and tear of that asset as an expense, but you're not actually losing value or losing money out of your bank account. So the IRS looks at it as a paper loss, right? You're only losing that value on paper, which is good for your business because that decreases your taxable income, meaning you pay less in taxes. So when it comes to real estate, this is the best tax benefit out there. Depreciation is calculated as the value of the property minus the value of the land divided by the depreciation schedule, which is 27.5 years is what the IRS allows you to depreciate an asset over. So what does that actually mean? Let's say that you have a property that is worth $100,000 and the land is worth $80,000, right? So you take your $100,000, subtract $80,000, you have $20,000, you divide that over 27.5 years, which will give you $2,900. So that essentially means that you're able to deduct $2,900 per year from your net income. So if we had a property that's cash flowing $200 per month, right? And over 1 year, we would cash flow $2,400. But if that same property was worth $100,000, $80,000 in land, like we just calculated, then that means we would get a $2,900 tax write-off. So $2,400 minus $2,900, what does that mean? I don't pay any taxes. This is why these millionaires and billionaires pay very little to nothing in taxes. Now, when it comes to stocks, there is depreciation available as well, but not to you as the stock investor. The depreciation goes to the company in which stock you own, right? Because they're the ones that own the real estate, they're the ones that own the business, and they're the ones that can write those things off and depreciate their assets that they own. You as a stock investor do not get that benefit. So again, round 2, depreciation, that's going to real estate. So right out the gate, it's not looking too good for stock investing, but we still have 3 more rounds. He can still come back if he wins all 3 rounds. So let's get into it. Round 3, equity. So what is equity? Equity is the difference between what you own and what you owe on an asset. So it's essentially your net worth in an asset that you own. Now, when it comes to real estate, the equity is in the property that you own, meaning if you own, let's say, $100,000 property with a $75,000 mortgage, your equity is going to be $25,000. So that being said, as the tenant is paying down that loan and chomping at that $75,000 mortgage, my equity and my net worth is going up every single month. So the tenant is increasing my net worth every single month. So you can easily scale and become a millionaire very quickly just by owning real estate and holding it. Someone is going to work every single day and coming back to make sure they can pay rent just to increase your net worth every single month.
I love it.
The best thing about real estate is that you can get equity in 3 different ways, right? You can get it from just the value of the property increasing over time. You can get it from fixing up a property and adding value to it. That gives you equity because it increases the value. And you can get it from the tenant paying down that loan. That gives you equity because you're decreasing that mortgage every single month. Now, in the case of a stock, your equity just comes from the increase in the value of that stock, right? That's the only way you can get equity. With a stock, you have to buy into that equity just to get any at all, right? So if I buy a stock at $20, right? I'm already in at 20, it increases to 50. Now my equity is 50. But 20 of that was my own money. I want to be able to get equity more creatively than just putting money into something. So that means your equity is at the mercy of the market, right? With a stock, I can't force equity like I can with real estate, right? I can't go tell the CEO, hey, do this with your company, do this with your company, and then do this so that I can, get more equity. So this can go up in value and I can get more equity in my stock. No, you can't do that. So your equity is at the mercy of the market, it's at the mercy of the politics, it's at the mercy of the CEO, it's at the mercy of the consumers, it's at the mercy of the employees. Your equity is not in your hands in the case of stock investing. As you might have guessed it, real estate is taking round 3 equity, and you know what that means. Real estate is the ideal investment vehicle.
Here's Shaq against Dudley. Nice!
But let's see if stock investing can make this a little more interesting when we look at the final 2 rounds. Appreciation and leverage. So appreciation, what is appreciation? Appreciation is the increase in value of an asset over time. When it comes to real estate, typically real estate naturally appreciates about 3% per year, depending on what area you're in. If you're in a more, high demand area like Los Angeles or Austin, Texas, or Miami or New York, you'll get higher appreciation. But this is what makes people a millionaire with real estate, right? Because real estate typically always increases in value. It is not as volatile as the stock market can potentially be. So it's typically easy to become a millionaire just owning real estate and doing nothing with it. But the best thing about appreciation in real estate is that there's natural appreciation that I just talked about, where it just increases due to the market and, economy and things that are really out of your control. But there's also forced appreciation, meaning that you can increase the value of the asset yourself by going in there and fixing it up. And then, that essentially will increase the value, right? Because it's a more desirable property. It's in higher demand. So people would pay higher for it, meaning it has to be worth more. But not so fast. When it comes to stocks though, historically, the S&P 500 has given on average 10 to 11% returns. So it's not bad. Typically you get pretty good average annual returns if you're just a long-term buy and hold stock investor. However, as we know, the stock market is a lot more volatile because there are a lot of factors in play, right? You have politics in play, you have CEOs in play, you have consumers in play, you have global economics in play, things that are completely out of your control. Yes, you can say the same about real estate. However, you are many more degrees removed from control of your asset when it comes to the stock market. If there was one round I would give to stocks, it would be appreciation, because when it comes to stocks, that is the main reason you're buying stocks, for the increase in value over time. But when it comes to real estate, That's not the main reason we buy real estate. We don't buy real estate for appreciation. That's just icing on the cake. We buy real estate that cash flows and produces income. That's the reason we buy real estate, because we're buying real estate for financial freedom. This is the ideal investment vehicle for financial freedom. But that being said, I still have to give this one to real estate because of the forced appreciation aspect. I can go in there and increase the value myself if I really wanted to. And I only buy properties in which I can go in there and increase the value. I don't go buy properties in which I don't have opportunities to increase the value. So that's what you need to be doing when you're buying real estate. So round 4, we'll be going to real estate as well. So that brings us to round 5. Can stock investing pull one out of the bag at the last minute? Let's see. So what is leverage? Leverage is the ability to borrow against the value of an asset, right? So essentially you're using other people's money, aka OPM as I like to call it. So in the case of real estate, typically, if you go to a bank or to a hard money lender or to most people, they would love to lend on real estate. In fact, they will lend you, 80%, 96.5% if you're doing FHA, or even 100% of the value of a property if you're doing a VA loan. That is insane. So essentially what this does is that it allows you to scale a real estate portfolio a lot quicker, right? Because you don't have to go and save up the entire amount or have the entire amount in cash to be able to buy this asset. You can buy it leveraged, right? You can buy it using OPM, right? And guess who's the one paying it back? That's the best part. I'm not the one paying it back. It's the tenant that's the one that's paying it back. When you buy real estate, you're essentially buying a business, right? Because when you buy a business, you're buying something that can produce income, right? So when you're buying income producing real estate, you're essentially buying a business. Think about how many banks or financial institutions are actually lending 80 to 100% on a business. There's none. People love to lend on real estate because that money or that loan is going to be backed by an asset that's increasing in value. Think about that. No matter what happens, this asset, as if I was to, default on this loan or whatever the case may be, I can't pay because I'm a fool, whatever happens, they get to take an asset that is now at least worth something and is going to continue to increase in value. So it's great for banks. Banks love to lend on this. And when it comes to stocks, typically you can only get up to around, according to Charles Schwab's, you can only get up to around 50% loan to value, meaning they'll only give you up to 50% of the value of that security to be able to buy that stock. So it's obviously not as great. I've never heard of 100% leverage stock. And of course, you don't have a tenant that's going to be the one paying it back. It's you paying it back. So in the case where obviously the stock market can be very volatile, let's say I bought a $100 stock with 50% leverage. Now I'm in it for $50 and I owe that broker, let's say the other 50% because they lend it 50% LTV. Let's say that stock was to drop in value to $50. That means I lose my 50 that I had in there, right? And the brokers gets their 50 back. They still have to get their 50 back. So you have to give them the remainder of it. So you essentially lost, $50 for no reason. And of course, you still have to account for the interest that you're going to be paying on this stock because they have to make money as well, duh. So it's a lot more volatile. It's a lot more risky trying to buy margin stocks. So I would much rather prefer to buy an asset in which people will be happy to lend to me and, there wouldn't be no problem. And I know it's a lot safer in terms of the returns because the market is a lot more stable when it comes to real estate. In the case I had a loan on a property and the value drops, I wouldn't care at all because I'm not the one paying back the bank anyway. As long as the property, because I bought the property cash flowing, so I'm still making money even if the value drops. That tenant is the one that is paying back that loan because they're still living there. They don't know or care that the value has dropped. All the tenant cares about is that there's a roof over their head. So that's all they're paying for. They're not paying me for the value of the asset. So it's a different game. So that being said, as you might have guessed it, please ring the bell. Get stock investing out of there. He is getting pummeled. Real estate is winner of round 5 and ultimately declared the ideal investment vehicle and the champion today. So as you can see, real estate is a much better investment vehicle than stocks are. If you have to dispute this, then I don't really know what you could say to dispute this. Let me know in the comments below. I would love to argue this with you. I would love to. We can go back and forth because I got some time. But that is it for this video. I'm gonna get stock investing out of here. We need to get him to an ER ASAP because he's on life support. So y'all be sure to give this video a thumbs up, man. I put a lot of effort and time into these videos, and so that YouTube algorithm needs to know that this is good content so they can continue to push it out so that more and more people can see this. So be sure to give this video a thumbs up, share this with a couple people. I'm trying to really grow this page. And yeah, that's it for this one. I will see y'all in the next video.